the new account is a new to Phillip client, all right, can use your unique link to share with your friends and family members to get this reward. It must be a unique link that you send to them. How you generate this unique link? You must scan the QR code, generate through keying in your personal account number. They give you a link to share friends and members to actually open an account. Next, we do have the share financing, all right, promotion, which is currently the margin promotion rate at 4.25% for Sing dollars, 5.88% for US dollars, 5.5% for Hong Kong dollars. So you trade in Hong Kong market, Singapore market, or US market, there is this financing rate to leverage on your position or your portfolio. To utilize less capital, you can leverage further using the margin trading account. So this is for the margin account, not cash plus, margin account. All right. So if you're not yet also join our Telegram group and get some market updates, all right, on the news, on the different market updates itself, you can go to this link, all right, and join our Telegram group as well. So without further ado, I'll pass the time now to our Hong Kong strategy speaker, right, Mr. Louis, right, to share on the Hong Kong market itself. Okay. So Mr. Louis Wong is a director of Risk Securities Hong Kong, and he's here personally to share with us on the Hong Kong market as well. Right, bring your hands together. Thank you.
Hi, good afternoon. I wish to see a show of hands. How many of you have listened to my presentation before? Can I see a show of hands? Some not as many as I expected. Okay. I used to come to Singapore to do physical seminars before the COVID epidemic. But since the COVID epidemic, I still do online through Zoom, online seminar, webinar for Singaporean investors, for Singaporean investors in Singapore. So every quarter, I will do two, one in English, the other one in Putonghua, in Mandarin. Okay. So actually every day, just to mention that if you have a YouTube account, you can also see me on YouTube, Phillip Hong Kong, our Phillip Hong Kong channel, with 3 videos every morning. In Chinese, it's called 开市起跑线, meaning market opening bell, giving you the first-hand information of what happened overnight in Hong Kong as well as in the US. What are the key factors to watch out, or the most happening news in the market for the for that day. Okay, so you may subscribe to our YouTube channel and view the daily video from Phillip Hong Kong. It's 开始起跑线 market opening bell. Okay.
Yeah. Okay. Okay. This is a disclaimer. I will start with our view on the global economic outlook, and before that, how can I go back? Go back to the first page. Yeah. So these two photos actually summarize our thoughts on the global economic outlook. I think, like it or not, going forward will be affected by these two key factors. First one is tariff policies, US tariff policies. I think overnight you heard the news. One good news, one bad news. Good news is US said China has finalized, they have not signed it yet. They have finalized the terms with the US, and China acknowledge it. This is also important. Whether for some time it's always 自说自话. Trump always say whatever he wants to say. You need the confirmation from China as well. This time it's confirmed by China that they have finalized the terms. Why? I just did talk a little bit why China is willing to cave in or to come to terms with China, to US, and vice versa, because China has the most powerful card. Trump always said you don't have any cards, but China has its cards. You know what cards China has? Rare earth, right? Rare earth is widely used in EVs, airplanes, a lot of things. So US needs rare earth from China. And what does China need from the US? Semiconductor chips. So this is Trump's card. He can offer, by removing restrictions on technological export to China. Okay, so the other one, the other pick on the right hand side is geopolitical tensions. Namely, now you have the Iran-Israel conflict, and the Ukraine and the Russia war is still ongoing. And in South Ocean, Nanhai, the situation is getting a bit tense, and also Taiwan Strait. So we will be facing these two key factors going forward. One is US tariff policy, and the other is geopolitical tensions. Okay, so we expect slower growth going forward, especially in the second half of 2025. The global economy is facing a challenging environment in 2025, admittedly, with trade policy uncertainty and geopolitical risk weighing heavily. So for the global GDP growth, the World Bank forecasts global GDP growth at 2.3% for 2025, a notable downgrade from earlier projections because of the two factors I mentioned just now. Whereas the IMF projects a slightly higher 3.3% growth for both 2025 and 2026, stable but below the historical average of 3.7% from 2000 to 2019. And the OECD anticipates a slowdown to 2.9% in 2025. So Phillip, Hong Kong, we project around 2.5 to 2.6% global GDP growth. So that's the global economic growth projected for 2025. As for the United States, GDP growth for 2025 is predicted to be around 1.3% to 1.7%. So this week, I think Thursday or Friday, they released the first quarter GDP, which came in negative. Okay, US because of the US the tariff policies. So the first quarter was negative 0.7% for the US. Several factors are contributing to this slowdown, including the impact of tariffs, potential shifts in monetary policy that Trump is scolding Powell, Jeremy Powell, saying he's a stupid person because he cut rates too late and too slow. Okay, so this also affects the economic growth. But we also understand Powell's he has two mandates to serve. You know what are the two mandates for the Federal Reserve? One is inflation, to fight with inflation. The other one is labor growth, the labor market. So he has two mandates. Now, both mandates are being uncertain, highly uncertain, because of the impact from the tariff policies, and a general weakening of business investment as well. Okay, China, very important. I think today we'll focus more on China. Growth is projected at 4.5%, down from 5% in 2024. Impacted by US tariffs, but cushioned by fiscal stimulus. Actually, China has implemented a lot of fiscal stimulus, a lot of policies to prop up, to support the economy. I'll go into details later. Yet you can see China is still worth investing because the expected economic growth compared to Japan, to US, to Eurozone, China still is entitled to the fastest growth rate. Euro area growth is forecast at 0.8% to 1.1%, even lower than the US, hampered by trade tensions and a stronger euro. And they are like Canada. I think the Eurozone is also taking a very tough stance towards Trump, 对抗. So if they cannot come to a trade agreement sooner, it may impact the future growth for the euro area. Then emerging markets and developing economies. Growth is expected at 3.7% to 4.2%. In South Asia, it will be led by India. India's economic growth will remain robust as now more manufacturing is moving from China, the so-called China plus one, to many business owners. Now they have this China plus one strategy. 中国加一, 就是 in the past they solely rely on China for manufacturing. Now they have to have a contingency plan. They have to have a plan B. So plus one. And now they're saying it's Vietnam plus one, Cambodia plus one, because Trump is also levying tariff on Vietnam and Cambodia. So for those manufacturers, they may need to find another place to diversify the risk, the tariff risk from Vietnam and Cambodia. So from China plus one now becomes Vietnam and Cambodia plus one. Okay, so the next 10 days will be quite crucial, quite essential for investing not only in China, but also maybe in US stocks, because the suspension period is going to come to an end by 9th of, actually it's the 2nd of, between 9th of July and 2nd of July. Yeah, and last night I saw the Secretary of Commerce, US Secretary of Commerce, Lutnick, saying that 10 countries have almost reached an agreement with the US, and they are going to sign agreement, trade agreement, tariff agreement with 10 countries. I think that will include China as well, and India. India is also expected, but Canada and the Eurozone, it may be a little bit thorny, tricky for these two countries. Okay, so Middle East and North Africa's economic growth is expected to be around 2.7%. So you can see from the projected economic growth for 2025, China still boasts of the highest, the fastest growth rate. Okay, and then the other key factor to watch is inflation. Inflation remains sticky. Global headline inflation is expected to moderate from 6.4% in 2024 to 4.1% to 4.2% in 2025, further declining to 3.2% to 3.5% in 2026, driven by lower energy and food prices, unwinding supply chain disruptions, and the lagged effects of tight monetary policies. So you can see the cycle. Actually, this inflation started 3-4 years ago. You know the cause of the rising inflation? The Ukraine-Russia war. It disrupted the supply chain, the global supply chain, and causing raw material, a lot of goods to rise in prices and cause the inflation. Because inflation shot up, a lot of the central banks have to tighten their monetary policy. So the Fed raised interest rates as a result, as a response to rising inflation. So we have gone through this is what happened in the last 3 to 5 years. Now inflation is moderating, unwinding, as I mentioned here, unwinding supply chain, and luckily the Middle East tension has not made things worse. It seems for the time being, because Israel and Iran are reported to have come to peace talk. So the end that may help end the conflict, and oil prices have come down. So this time round, we do not expect a spike in inflation as caused by the as we saw during the Ukraine-Russia war. Okay, so inflation we expect to continue to moderate, but at a very slow pace. That's why the Fed is very hesitant in cutting interest rates, because inflation came down, moderated in a much slower pace than expected. Okay, inflation remains above central bank targets for US. The Fed's target is 2%, but now it's still hovering around 3%. So it has not come down to the central bank targets yet, with services inflation proving sticky due to rising wages and tight labor markets. I think it's common everywhere. In the US, wage prices have gone up, in Hong Kong as well. In Singapore, I think you are also facing the same problem. Tight labor markets lead to rising wages. Okay, US tariffs and potential supply shocks could keep inflationary pressures elevated in some regions. That's our call for inflation in the next 6 months. So inflation projected at 3.33% to 3.5% by Q3 for the US, 2025 driven by tariff related costs and services inflation. Later, I will also share with our projection of how many times the Fed is expected to cut interest rates and by how much. It is based on our inflation projection. Inflation will remain elevated, will remain sticky. Euro area inflation expected to hit 2.1%. So that's why you see the Euro Central Bank is cutting interest rate faster than the US, because inflation moderates faster in the Eurozone than in the US, supported by lower energy prices and competitive pressures from the US-China trade unwinding. So China now, going forward, may export more to the EU because of the US tariff. So this will help bring inflation down in the EU, because China, the cheaper goods from China will help keep inflation in the Eurozone subdued. For China, is another story. They are not facing inflationary pressure. Actually, on the contrary, they are facing deflationary pressures because of oversupply, weakening demand, with consumer price inflation projected at only 0.1% to 0.4% in 2025, driven by weak household demand and also a property slump that affects the people's consumption. And actually PPI, here is only CPI. China's PPI was in negative territory, down more than 2% for, I think, more than 20 months consecutive months. So this reflects China, there's oversupply and weakening demand. Okay, so monetary easing. We expect the US further cuts projected in 2025 with target range down to 3.5% to 4% by end of 2025. Now is how much? Now is 4.25 to 4.5%. So if by our projection of the Fed fund rate going down to 3.5% to 4%, which means we are expecting around 2 times, 2 rate cuts in the next 6 months, 25 basis point each. And so altogether, it will come down from 4% to 3.5%, between 4% and 4.25 to 3.5 to 4%. Okay, 2. But some investment banks are projecting either 3 or 1. Okay, to Phillip Hong Kong, our projection is 2 rate cuts by the Fed. Eurozone expected to continue easing in 2025 to stimulate growth, and also they are allowed to do so because their inflation is more subdued compared to the US. China, the PBOC, People's Bank of China, has adopted an appropriately loose monetary policy by cutting interest rates and reserve requirement ratios. RRR is the ratio that commercial banks have to keep their deposits, the reserve, with the central bank that they cannot lend out. Okay, so by raising reserve requirement ratio, the China Central Bank controls the liquidity in the banking system by allowing the banks to lend out less. So by cutting the reserve requirement ratio, banks are able to lend out more. So more liquidity. This is how by the 2 tools, we say 2个工具，一个就是利率 interest rate, the other is the reserve requirement ratio. They use it and they the Central Bank of China, they emphasizes appropriately loose. They don't want to be too aggressive. Otherwise, it will cause oversupply of liquidity, over investment. It will aggravate the oversupply problem. Okay, so they adopt an appropriately loose monetary policy, very cautious and very incremental. You won't expect very aggressive policies, initiatives from China, only very incremental and moderate approach. Emerging countries, India and Brazil, adopt also cautious easing. Okay, so this is between China and the US. When I did this slide, it was before Thursday, before the announcement from Whitehall and also the confirmation from China that they have finalized the agreement. Now, there are two subtle points here. Finalizing doesn't mean it's signed yet. So it's not signed by Trump and Xi Jinping yet. Once it's not signed, you can expect things to change. It's not a signed deal. It may be an agreed deal. It's not a signed deal. And secondly, even it's a signed deal, whether China will observe 100% is another issue. Remember, in Trump 1.0, his first term, US has also signed a trade agreement with China. China promised to import, I think at that time is 200 billion worth of goods from the US. But subsequently, China, I think they imported not, up to the agreed amount. So Trump was actually at that time was not happy. So this time, whether China will observe the agreement to be signed. So these are the still two uncertain points. Based on the trade framework, the US will maintain 55% tariffs on Chinese goods, much higher than the tariff levied by China on the US, because this includes pre-existing duties from Trump's first term, around 25%, and then existing 20% tariffs over illegal drugs that the US accused China, while China will keep 10% tariffs on US imports. So it's 55% on China and 10% on the US. And China agreed to ease export restrictions on rare earth minerals and magnets critical for US industries like automotive, defense, and electronics. The US will roll back some recent export controls, including restrictions on chip design, software, aerospace parts. I think this is also very crucial to China's development of its Dafeiji big aeroplane. The engine, a lot of the aeroplane parts are actually imported from the US. Without those parts and without those engines, China will not be able to roll out its big aeroplane, C919 and C909. So threats to cancel Chinese student visas were also withdrawn for the time being. It's not a done deal yet. Before I did this slide, they had not come out to say they have finalized the term. Now they said both sides said they have finalized the term yet, but it's not signed yet. And the implementation is also another issue to watch. The deal's success hinges on leader approval and sustained dialogue. And however, we have reservation for U.S. and China relations. It's more complicated than just trade, because there are other unresolved issues such as technology competition, non-tariff barriers, and the drug trade, and also the Taiwan situation, the Taiwan Strait situation, which may derail the trade talk progress. Okay, now what are the stimulus measures taken by China so far this year? Quite a lot. Increased budget deficit. China raised its fiscal deficit target to 4% of GDP in 2025 from 3.8% in 2024, signaling a more proactive fiscal stance. This allows for an additional 1.6 trillion yuan in central government spending. So the Chinese government will spend more to support the economy. And then they will borrow more. The other thing is, if you want to spend more, like your credit card, actually you borrow more, you assume more debt. So China will issue 1.3 trillion yuan renminbi in ultra-long bonds in this year, up from 1 trillion last year, to fund economic support measures. Okay, and then they have to step up the support to the local government. Okay, local governments were permitted to 4.4 trillion yuan in special debt also up from 3.9 trillion yuan in 2024. And additionally, a 10 trillion yuan, 哇，那个是10万亿 5-year debt swap program was announced in November 2024, aims to ease local government hidden debt, saving around 300 billion yuan annually in interest. So I think it's known fact that a lot of the provincial governments in China have a lot of hidden debts. So to resolve it instantly, there's no instant solution, because to resolve those debts, you repay lah. I mean, it's easy. You get money and repay the borrow the lender, then it's resolved. But the problem is they don't have the money. So now they are using a debt swap program, issue more new debts to repay the old debts, but with the backing of the central government. So now, if you still trust the central government, and honestly speaking, the credit rating is still okay lah. I mean, for China to issue treasury bonds to support provincial government. And then consumer subsidies. A consumer goods trade-in program was expanded to 300 billion yuan in 2025, doubling from 150 billion yuan in 2024. And they have expanded the scope of goods that can be subsidized. Now, handphones, PCs, a lot of electronic goods are eligible for receiving subsidies, consumer subsidies. And then state bank recapitalization. China allocated 500 billion yuan to recapitalize major state-owned banks, strengthening the capacity to support economic activities. So they come in many different fronts to support the economy, not just by cutting interest rate, not just by lowering the reserve requirement ratio. Actually, they have done quite a lot. And then policy rate cuts. The PBOC reduced the reserve requirement ratio by 0.5 percentage points each in September 2024 and May 2025, injecting about 2 trillion yuan in long-term liquidity, with potential for further cuts of 0.25 to 0.5 points in the second half this year, depending on market conditions. So bear in mind, every 0.5 percentage points cut in the RRR, in the reserve requirement ratio, will release 1 trillion yuan in liquidity for banks to lend out. So every 0.5 percentage points represent 1 trillion yuan liquidity. Okay, interest rate cuts. This year, the PBOC implemented several interest rate cuts to support economic growth amid challenges like a property slump, deflationary pressures, and trade tensions. But the PBOC is quite stingy lah. Every time it's only 0.1% to 0.15%. They don't want to take aggressive moves. So they emphasize, just now I said, appropriately loose policy. In Chinese there's a word they always mention, 大水漫灌，有没有听过？大水漫灌就是 a lot of water flooding the banking system. They don't want to do that. They don't want the flooding of liquidity. 大水漫灌 they want 细水长流一点点的 increment。那细水长流不是他们说的，是我说的大水漫灌是他说的肯定的。那个细水长流是我的 interpretation。Okay. Liquidity injections in June 2025, the PBOC injected 200 billion yuan through reverse repo operations. Oh, this is very important because they want to support stock market. This repo is used to support stock market, to lend money to the owners of listed companies to buy back the shares for share buybacks, or to lend money to listed companies to do share buybacks, and also to lend money to brokers to provide financing to investors to buy stocks. So they want to pop up. So that's why since September last year, you notice the A-share market, Shanghai composite stock, very stable, always at between 3,300 and 3,400. And Hong Kong, I'll show you later, is also supported by the Chinese government. Whenever there's a drop, they will come in. The so-called national team, 国家队不是足球的那个 足球的那个我中国会输的啊，但是在那个金融的国家对中国是赢的啊。OK， depreciation pressure. For a time, investors are worried. When you invest in China, you must be worried about the currency risk. The exchange rate, renminbi weaken, then you lose in the exchange. You gain in the share price, but you may lose in the exchange. But surprisingly, since the tariff policy, the announcement of the tariff policy, the renminbi actually strengthened instead of weakening. Although in going forward, it may still face downward pressure due to lower interest rate. China is still in a rate cut cycle. We expect more rate cuts from PBOC, and the trade tariffs. China may need to depreciate the yuan to help its exports. That's one thinking in the market. But actually, the renminbi did not weaken too much, and also it will be impacted by weak domestic demand. Actually, we expect a two-way fluctuation, two-way volatility on the renminbi. Like last year, it fluctuated between 6.85 yuan to $1 and 7.5 to $1. So this year, we also expect two-way volatility. It will either appreciate or depreciate, depending on a lot of things the international trade balance and also the trade policy, the trade talk between China and the US, and also global monetary policy shifts, which central banks are cutting rates faster. It also have a bearing. Will have a bearing on the renminbi. And then stabilization effect efforts. I think this is one of the key reasons why renminbi did not weaken as expected, so much as expected, is China's robust reserves, foreign reserves, and PBOC's interventions will limit extreme depreciation. They don't want the renminbi to depreciate, because for China, if renminbi depreciates too much, yes, it will have exports. But on the other hand, will cause capital outflow. Now, China is already seeing capital outflow. For the first 5 months this year, FDI drops in China for the first, I think, in 20 years. FDI to China always rise every year. More foreign direct investment into China. But this year, we saw FDI declining in the first 5 months. So stabilized renminbi will also ease capital outflow. Okay. Another positive for the renminbi is internationalization. The renminbi's growing international role will support its medium-term stability. Okay, so you can see the movement of the yuan versus the US dollar. In April, after the announcement of the tariff policy, people panic. People think China may allow the yuan to depreciate a lot so as to help the export. So it dropped to about 7.4 to the US dollar. Now it strengthened to 7.16, very strong. Recently, the renminbi is actually quite strong compared to the US. Both offshore, onshore yuan are trading at around 7.16 yuan to $1. Okay, so you see the two-way volatility going forward. And reasons for the renminbi strength, first of all, is the depreciation of the US dollar. It has led to a passive appreciation against the dollar, with growing market pessimism about the US government's fiscal deficit and rising debt exacerbating the recent sharp decline in the US dollar index, pushing up non-US currencies, including the renminbi. So it's not because China is the economy is very strong, but more because of US dollar. It's weakening itself. The recent intensification of more proactive domestic macroeconomic policies has enhanced the resilience of China's economy against external fluctuations, providing internal support for the renminbi exchange rate. That's why I showed you just now all the stimulus measures, policies adopted by the Chinese government. So this helps stabilize, provide strength, lending support to the renminbi. Okay, now come to the stock market. Just now it's all on the macro economy. Hang Seng Index now up to Wednesday. Before I gave this slides to Singapore, Hang Seng Index was up 22% year to date. Actually, you can see the volatility. It's like a bit like roller coaster this year. So far, rising the Hang Seng Index rising from 18,671 to a high of 24,874 in March before the announcement of Trump's tariff policy. And then in early April, it tumbled to 19,260. So it's dropped 25% from the peak in March. But subsequently, you can see recovery. It has recouped almost all the losses. Now it's up 27% from the low. Now it's trading around 24,500. We expect the Hang Seng Index to be able, because of the improvement, also the trade talk, if it's finalized and signed and being implemented, observed, with the also more economic stimulus measures from China, we expect the Hang Seng Index is set to challenge this year high of 24,874 seen in March. So our target for the Hang Seng Index, if it manages to breach the resistance level seen in the March peak, we are expecting 25,500 to 26,000 for the Hang Seng Index this year. Okay, Hang Seng Tech Index, you can see it becomes a laggard in the last 2 months. If you may have noticed that because some of the heavyweight tech companies are not moving, like Alibaba, Tencent, JDcom, as well as Meituan. These four, they are under pressure, so that drags down the Hang Seng Tech Index. Yet there are still some tech companies that are doing well. I think one of those is Xiaomi. Xiaomi yesterday it saw a new record high. I will talk as I noticed just now. Singapore, you can trade Hong Kong stocks through the SDR, the depository notes. So today I will cover all the company outlook of the 11 SDRs. 11大侠不是 the Magnificent Seven, the Hong Kong 11 那个是足球队的那个the football team number 11 SDR listed in Singapore. I will share with you our view on their company outlook. What are the headwinds and tailwinds, and which one is worth for investing? Okay. Just now I mentioned national team, not football, is deployed to support capital markets. The national team refers to state-backed entities such as Central Huijin Investment, Zhongyang Huijin, China Securities Finance Corporation, abbreviated CSF, sovereign wealth funds, 主权基金, 社保基金, China Investment Corporation, and state-owned enterprises. They will do equity market stabilization through direct stock purchases. And increasingly, we notice they, instead of buying up individual stocks, they now acquire more ETFs. By acquiring ETFs, actually is more direct and more simpler to support the stock market. You buy up the ETF, the index will go up because results in creation in ETF units, and subsequently it will result in more demand for shares. Okay, and also SOE buybacks by a lot of state-owned enterprises. And then people see, just now I mentioned, they provide the liquidity. They lend money to listed companies as well as stockbrokers to allow the investors to buy more stocks, and also to prevent forced liquidations when market drops. Debt market support through bond purchases to cap yields and ensure refinancing for indebted firms. One problem faced by the bond market in China is because there's too much demand for China treasuries. Bank deposit rates in China is very low, and then stock market for a time is just moving sideways. So a lot of money in the past they went into the property market. Now investors in China they dare not buy property stock. They have reservation. So what do they invest? They invest in treasury bonds, and that caused price to come down and the yield to go up because there's more demand than supply. So price go up and then the yields come down. So they want to cap the yields and ensure refinancing for indebted firms. And then short selling curbs and IPO delays. And the IPO delays in China actually helps Hong Kong because a lot of the companies that are planning a listing in China, in the Asia market, now they come to Hong Kong because the door there is closed. House is full. You go elsewhere. In the past, they have more options. They can go to US, they can go to London, but now I'll also talk later. The US, they are talking. Trump has threatened to delete the Chinese companies listed on US exchanges. So that will also lead one option to those companies is to move to Hong Kong. So Hong Kong benefits. Okay, southbound fund flows. As of June 17, the total trading volume through Shanghai, Hong Kong Stock Connect. Now, for Chinese investors to invest in Hong Kong, they cannot do directly unless they have a Hong Kong account. But this is also actually not allowed by the Chinese government. So they only allow their mainland Chinese to invest through the Stock Connect. This is the Shanghai Hong Kong Stock Connect and also Shenzhen Hong Kong Stock Connect. You can see the turnover, the trading volume adding together is 11.5 trillion. And the combined southbound fund trading volume amounted to 11.52 trillion in the first, as of June 17, surpassing the full year 2024 total of 11.23 trillion. So only 6 months, the trading volume from China via Shanghai and Shenzhen already surpassed the full year total trading volume in 2024. That explains why, now Hong Kong daily turnover, how much? It's 200 billion Hong Kong dollars. 100 billion Hong Kong dollars is about 40 billion Sing, right? 40 billion Sing. 40 billion Sing. I was told it's more than 10 times the daily turnover in Singapore exchange. Okay, so increasingly, main southbound funds. Southbound means funds coming from north. So it's southbound, heading to Hong Kong. And regarding net purchase amount, so this is trading volume. Sometimes you buy, sell. It can be very big. But what matters most is net buy or net sell. Okay, I'll give you the figure. Regarding net purchase amount, since the start of this year, Shanghai Hong Kong Stock Connect recorded a net purchase of 493.1 billion Hong Kong dollars. That's near 100 billion Sing. Okay, and Shenzhen Hong Kong Stock Connect recorded a net purchase of 193.9 trillion Hong Kong dollars, both significantly exceeding the level from the same period last year. Which means what does that mean? It means mainland Chinese now had actually acquired close to adding together is 680 billion trillion net purchase. So that explains why Hong Kong market managed to rebound so fast. One of the reasons is a lot of southbound funds coming to Hong Kong to pick up Hong Kong stocks. Okay, now Alibaba company outlook revenue. This is our projection for financial year 2026. This financial year is March. Year end is March. So now it has just announced the first fiscal quarter. Okay, we expect its revenue to grow 6% to 1,055 billion yuan, in financial year 2026, driven by cloud's double-digit growth and triple-digit AI product growth. This is the growth area for Alibaba. No more e-commerce. Actually, e-commerce is a drag on Alibaba because of the competition, very tense competition from Pinduoduo, from JD.com, even from Meituan, which is entering also the e-commerce arena. Okay, but other growth areas will also partner with Apple. iPhones China, Apple Intelligence will be supported by Alibaba's AI model. Okay, net profit expected to grow 5% to 13.5 billion yuan, with high AI capex potentially pressurizing near-term margins. So inevitably, Alibaba and other also tech companies, they have to spend more in AI. Okay, they have to invest for future. Okay, what are the risks Alibaba is facing? Competition, as I mentioned just now, from JD.com, Meituan, Tencent, and Pinduoduo erode market share in e-commerce, instant retail, and cloud services. And US tariffs and tech restrictions could impact AIDC. AIDC is the outshore e-commerce under Alibaba, and cloud growth as well. US companies in the past using cloud service in China provided by Alibaba may in future not be able to, we may have to switch to Amazon. Okay, so this will may restrict its cloud growth related to US companies or US clients. AI monetization delayed by slow adoption. Now is investing more in AI. So how long it will take for those AI investment to monetize, to bring revenue and profits to Alibaba, it is key. Okay, or pay AI services by Chinese businesses. Companies, users are willing to pay, not always use free services. This will dictate the monetization time. Okay, and regulatory scrutiny is still there on tech companies in China. Okay, our near-term resistance projection is $120. You can see the black line there is the 100-day moving average. In the past 1.5 months, it meets resistance, quite strong resistance around 120 Hong Kong dollars. And the key resistance will be 130. Okay, near-term support is 108 Hong Kong dollars. Key support is 98 Hong Kong dollars, which was seen in early April after the announcement of the US tariff policies. Tencent revenue expected to grow 7.6%. So Alibaba will expect revenue growth of 6%. Tencent will be slightly faster. We expect 7.6% revenue growth to 710 billion yuan in 2025, driven by gaming recovery with new approvals and global hits. So Tencent is more resilient because gaming, online games are less susceptible to like consumer goods. You may buy less, but online games, people may not play less in an economic downturn. They may play even more if they have nothing to do. If they are unemployed, maybe WeChat's ecosystem now, Tencent is making use of its WeChat's ecosystem, 那个微信的subscriber user to do e-commerce via video accounts and also 视频号 and also mini shops 微信小商那个小商店 boosting advertising and also e-commerce revenue that's being done by Tencent. It's also expanding its AI and cloud service. It has its own model called 混元 LLM. Okay, Alibaba's 模型是叫 Quen QWEN. Tencent is 混元 HUNYUAN. Okay, net profit expected to grow 10% faster than revenue growth. So Tencent, I think just Alibaba and Tencent, which is better. If you look at the projected revenue growth and also the net profit growth and also the potential risk challenge, we think Tencent is better than Alibaba. Alibaba will grow slightly slower than Tencent and also facing more headwinds. Okay, risk for Tencent: regulatory uncertainty on gaming could disrupt growth. If they don't allow, they are fearful of the youngsters, Chenmi, spending too much time playing games. That is one potential risk. Competition from ByteDance, 字节跳动, is the owner of Douyin, Alibaba and JD.com on advertising, cloud and e-commerce segments. But one speculative news is it is reported to be looking to acquire Nexon, another game developer company, could boost gaming and crypto exposure. Tencent, our near-term resistance for Tencent is $520 Hong Kong dollars. Key resistance is 540. Actually, if you look at the chart, which one is closer to the March peak, Alibaba or Tencent? Which is closer? Tencent is closer. It's only $20 odd from the March peak. So it's in a sense, it's the share price is stronger compared to Alibaba. Key near-term support is expected around 495 Hong Kong dollars. Key support at 480. So this may also be the entry price we recommend it, because those are the near-term support and key support. If there's any correction dropping to those areas, I think it's also a good entry price suggested by us. Meituan revenue forecasted to grow 12% to 378 billion yuan in 2025. Net profit expected to drop 15% to 30.5 billion, reflecting competition and also Kita losses. Kita now is already in Hong Kong, and Kita is now expanding in Middle East, in Saudi Arabia. I'm not sure if Kita will come to Singapore. And that, so Meituan, if you compare to Alibaba, Tencent, I think for the time being, it's not really as attractive as Alibaba and Tencent, because revenue is expected to grow, but net profit expected to drop 15%. Okay, risks. What are the risks? The inherent risks: JD.com's food delivery entry and Pinduoduo's grocery dominance threaten margins and market share. JD.com is grabbing its cheese, stealing its cheese. Aggressive marketing and rider benefits may reduce operating profit by around 10% in 2025. So JD.com food delivery, they claim they have already recruited 125,000 qishou riders. So it will pose a serious, severe competition to Meituan. Kita's rapid expansion in Saudi Arabia also will increase short-term losses, because you invest more subsidies there will lead to more losses. Potential government intervention to curb irrational competition or broader regulatory pressures. Okay, and then JD.com launched JD Takeaway, the food delivery service, in February 2025. Only in 4 months' time, you can see by May it achieved 25 million daily orders, about a fourth of Meituan's 2024 peak of 98 million. So Meituan is losing market share in the food delivery market to JD.com. And recently, if you read in the news, Alibaba's, it also has a delivery business called 饿了么. Are you hungry? 饿了么. Are you hungry? Now they are increasing the subsidy. They are reported that they will increase 1 billion yuan subsidy to strengthen their 饿了么. I think they are really hungry now, hungry for business. So they need to step up the competition among the three. Okay, 三角大混战, like in the three warriors, three countries, 三国时代. Okay, JD offers merchant signing up before May 2025, zero commission fees, undercutting Meituan's 6 to 8% rates So Meituan will be under tremendous pressure, I can tell you. JD is the first platform to offer full-time riders direct labor contracts. In the past, Meituan don't treat the riders as their employees. They are contracted, so they don't need to bear the social security. But now JD is the first platform to offer this kind of security, social security, insurance, and housing funds, aiming to hire 150,000 riders by the end of 2025, which will force Meituan to announce similar benefits starting Q2 2025. So it will erode the margin further. JD has rolled out aggressive subsidies. Example, 30 yuan off 30 yuan being spent. So it's almost like free 消费30元你可以有30元给你rebate and promises 30-minute or faster deliveries. Its express supermarket delivery targets Meituan's flash purchase business. So actually, share price can tell, right? Tencent, you look at the share price, it outperforms Alibaba. And if you look at Meituan share price, it underperforms Alibaba and Tencent, okay? Because of the factors I pointed out to you just now, okay? So sometimes investors tend to buy stocks that underperform. In our minds, you need to analyze why the share price underperforms. It must be there must be reasons, there must be causes. If those reasons or causes don't disappear over time, it will remain underperformed. So don't buy things because it's cheap, especially stocks. Don't buy stocks just because it's cheap. There's always a reason for being cheap, okay? So our near-term resistance projection is 138 Hong Kong dollars, near the 50-day moving average, the blue line. And then key resistance will be 150 near the black line, the 100-day moving average. Near-term support, if you still look at buying Meituan, one near-term support is around $126. Another key support is $120. Okay, JD.com revenue expected to grow 5.95% to 1,022,227 billion because it's e-commerce. The revenue is very big. More or less like Alibaba. Alibaba, we expect the revenue to grow 6%. So JD.com, we expect 5.5% growth in revenue, driven by low price strategy, expansion of third-party marketplace, and China's economic stimulus boosting consumer spending. Net profit expected to grow 9.5% to 52.3 billion yuan, slightly faster than Alibaba, okay? But it's also fueling some inherent risks, such as competitive pressures from Pinduoduo and Douyin, increased investment in subsidies, food delivery, and OTA. Now, Trip.com is also facing the competition from a new entrant, that is JD.com. OTA stands for Online Travel Agency. So recently, Trip's share price also underperformed. It's because they are facing new competition from a new competitor, okay, and potential tariff-related cost pressures, okay. JD.com, actually, if you look at share price, it performs more or less in the quite similar to Meituan, also very weak. So from the 4 stocks I mentioned, the share price performance, the strongest one is Tencent. The second one is Alibaba, and then Meituan and JD very weak. Near-term resistance is expected around 135 Hong Kong dollars, and then key resistance is 143, where the black line, the 100-day moving average lies. Near-term support 121, and key support is expected to be around 110. Okay, let me see the time. Ooh, I need to speed up. Xiaomi, I think this is a performer, 明星股, forecast to grow 23% to 30% to 450 to 475 billion in 2025. Xiaomi just this Thursday rolled out its YU7 SUV. Wow, very hot response. It's reported that it received 290,000 orders for pre-book orders for YU7, selling at around 250,000 yuan per unit. Okay, so it's targeting 350,000 units together with SU7. I think they will be able to achieve it because in the first 5 months, they already deliver, I think, around 130,000 units of SU7. And now they have received another 290,000 orders for YU7. So the two added together is now it depends. Okay, we always say for Xiaomi EV, the issue is not order, 不是订单，问题不是订单，是交付，是 delivery. Is how quick it can deliver to its the orders, okay, to the buyers, okay. And now in China, you know, there's Huang Niu, YU7 scalpers, scalper. If you get place an order, that means you have you confirm the order, you can get 20,000 yuan, 2万，把那个单转卖给另一个人，炒黄牛啊！你知道演唱会啊 ，concert you have scalpers. Now YU7 also have scalpers. You pay 20,000, you get the car delivered faster. Okay, because the order is accepted and confirmed. Smartphones is targeting 180 million units, up 6.8%. Not bad. The above average increase with high-end models, Xiaomi 15 series boosting margins. On Thursday, it also rolled out its latest handphone. It's called Max Flip 15. I think it's a flip handphone. You know how much it's selling? It's selling at 5,999 yuan, so close to 6,000 yuan. In the past, Xiaomi is known for its cheap model, very cheap. Xiaomi less than 2,000 yuan, but now it's moving up. It's premiumization. It's called the strategy premiumization. It's selling higher, more high price, high rent models, and that will imply better profit margin for Xiaomi. Okay, IoT, Internet of Things, which stands for Internet of Things, expanding retail network, 1,500 stores in China by end of 2025, and 10,000 overseas by 2030. I think there must be a lot of Xiaomi shops in Singapore as well. Net profit expected at 34 billion yuan, or up 44%, assuming EV losses narrow. Still losing money, but we expect it will turn around faster than expected, and smartphone IoT margins to improve because of more high-end models. Okay, look at the share price. Share price is it tells, right? Actually, this is done on Wednesday. Now it has already surpassed the March peak because on Friday yesterday, intraday high was above 60 Hong Kong dollars. It closed at 58 something. So it is now the first tech companies to surpass the March peak seen this year. So very strong, the share price. Near-term resistance 59. Key resistance above $60 will be around 64 Hong Kong dollars. Near-term support, if you want, we intend to buy Xiaomi, wait for correction. If in case the share price corrects to 53, we think there's a good entry level. So key support is 48, but barring any unforeseen circumstances, I think it's quite the chance to drop back to $48 quite low. Okay, SMIC, expect revenue growth at 7 to 10% in 2025. Actually, this is expected by SMIC, the company itself, driven by consumer electronics recovery and China's localization push. China does not want to be over dependent on the US, so is trying to promote localization in the semiconductor industry. Net profit projected at 500 to 600 million US dollar compared to 492 million US dollar in 2024, flat to slightly up only, constrained by mature node pricing. I think one issue for SMIC, don't treat it as another TSMC. It's not TSMC. It's by no way, by no means TSMC or NVIDIA, because its product mix is still, I think, 70 to 80% of its product belong to the mature node. Mature node means 45 nanometer and at most 28 nanometer. But TSMC, they are now talking of about 3 nanometer, 2 nanometer. So those sell at a much, much higher price, okay? But for SMIC, it still has a competitive edge. You know why? Because Samsung, competitors like Samsung and TSMC, they don't want to do those mature node. So now no one manufactures the lower end. That allows SMIC to dominate the mature market. But the margin is low, it's very thin. The volume is big, but the margin is thin. Okay, bear in mind that. And capital expenditure, they have to keep investing, doing a lot of R&D to catch up with TSMC and NVIDIA. It costs money. So if they plan at $7.5 billion in 2025, up from $7.33 billion in 2024, reflecting cautious expansion amid mature node oversupply. Okay, risk, tariff and restrictions on semiconductor manufacturing equipment. If US impose restrictions on the export, not only from US, also from its partners, strategic partners like Netherlands, SMIL is not allowed to sell semiconductor manufacturing equipment. That will also impact SMIC, slow down or lengthen the time to catch up with TSMC, Samsung, and NVIDIA. Okay, and Samsung, not NVIDIA, sorry. And components could raise costs, disrupt its equipment upgrades. Okay, SMIC chips are mostly sold domestically, but it has a big domestic market. 86.6% of revenue from Chinese clients in third quarter last year, or to non-US markets. So it faces minimal direct tariff impact. Okay, domestic demand for SMIC's chips, especially for Huawei and other local tech firms, has surged as US sanctions cut off Western alternatives. This is one saving grace or silver lining. Okay, the trade war has accelerated China's drive for semiconductor independence, benefiting SMIC through government support. It's expected to receive more subsidy from the government. Tariffs on semiconductor manufacturing equipment or components could indirectly raise costs, as SMIC still relies on global supply chains. So it lags behind global leaders like TSMC in advanced chip production due to restricted access to extreme ultraviolet, so-called EUV machines, and restrictions on US allies like the Netherlands. SMIL space could disrupt its equipment upgrades. Okay, the share price a laggard, I would say, but not as bad as JD.com and Meituan, because it still enjoys the dominance in the domestic market. It's only that the margin is under pressure. So near-term resistance expected to be around $46, where the 100-day moving average lies, and key resistance is expected around $50, still way below the March peak at $59.70. Near-term support is expected at $40. If you are upbeat, if you like SMIC, I think $40 is quite a good level, attractive level, resilient level. Okay, key support is 37 Hong Kong dollars. Okay, BYD, wow, a lot of mixed news recently. Sales target aiming for 5.5 million vehicles, up 29% last year, from last year, with 800,000 plus overseas, up 92%. So BYD is selling more cars, EV cars overseas. That's the trend, ongoing trend. BYD brand targets less than 10% growth, while premium brands such as Denza, Yangwang, Fang Chengbao aim for higher growth. These are the premium brands. BYD has quite many brands, so they target different price segments. Okay, revenue forecast to grow 10.7% to 15.8% to 860 billion to 900 billion yuan in 2025. At least double-digit growth in revenue. Net profit expected to grow 12%. Decent growth, I would say, not very impressive, but decent growth to 45 billion yuan due to higher sales volumes and premium model mix. Risk, price wars due to weaker domestic demand, tariff impacts, hidden debt involving selling receivables and accounts payable. Now, this is a big issue because BYD is reported to be having a very huge account receivables. Look at the number, 244 billion yuan in 2024. That's the money it owes to its suppliers. And in the past, it takes the turnover days. We look at the turnover days, the receivable turnover days. Normal turnover days is between 30 days to 60 days. 如果你们有做生意都知道，那个付款期一般正常是30 days to 60 days. So for BYD, you know what is turnover days last year? 182 days. 182 days. That means its suppliers is very 很惨的，你要等180半年才收到那个，但是没办法，因为你 you rely on BYD to 光顾你嘛 ，to buy from you. So and for BYD, actually it is seen as interest-free loan from the supplier. Providing the financing 免费的我有2440亿 244 billion in financing 那个周转给他周转 but this is going to change. Effective June 1st, 2025, the regulations on ensuring payment for small and medium enterprise funds issued by China State Council, very important, 国务院 China State Council require large enterprises like BYD, including automakers, to settle payments to SMEs within 60 days of delivery. So now no more interest-free loans. The regulation also prohibits using non-cash payments. In the past, they don't pay cash even when the 数期那个 receivable is due. They don't pay cash. They pay you promissory notes. That means I will promise to pay you in future. It's not real cash. It's just a kind of a guarantee from BYD that I will pay you in future. So it's caused a lot of the suppliers, the cash, the liquidity running into problems. And now no more. Prohibits the use of non-cash payments to delay settlements and also prohibit back-to-back clauses tying supplier payments to third-party progress. Sometimes they don't pay the supplier directly. They ask the supplier to collect from another third party. If the third party doesn't pay, it's not my business. You chase the third party. So a lot of loopholes that will be plugged. So BYD, before this issue, its price was performing was outperforming. You can see May, its share price hit year high at around $157. Now it's peaked. In the past, it used to trade more than $400. You may ask, why is BYD share price drop so much? No, because there's a bonus issue. They issue more bonus shares issue. So now, after the share split, its share price comes down to $130. So you can see after this incident, its share price has weakened quite substantially. And we think it's not over yet. So for BYD, we advise caution. Today's BYD may be different from yesterday or half a year ago because of the change in policy. Okay, near-term resistance is expected around 140 Hong Kong dollars. Key resistance 152. And then near-term support 120, key support 102. Okay, PetroChina Crude oil output is projected at 936 million barrels, will be down 0.5%. Output is expected no growth. Natural gas, we expect 4% growth year on year, and refinery output also expected drop. Revenue forecast to remain stable at 2.9 trillion yuan compared to 2.93 trillion yuan in 2024. Earnings net profit expected also to remain stable at 160 to 170 billion yuan compared to 164.6 billion in 2024. Now for PetroChina, one word to describe is stable, 平稳, 不会有, will not expect tremendous growth, but we also don't expect huge drop, will remain stable. Capital expenditure planned at 262.2 billion, down from 275.8 billion last year. But the dividend is very attractive. Dividend per share, we expect to be between 48 and 49, 0.48 to 0.49 yuan in 2025, compared to 0.47 yuan in 2024, yielding 8%. The dividend yield is 8%. So this one attractive. So you can see recently share price outperformed the market. First, because of the yield, I think the dividend yield helps. And secondly, it's because of the Middle East tension that pushed up the oil price. But that we see is only a short-term, temporary phenomenon that the oil price will surge. Now, actually, the oil price has retreated. Okay, but for PetroChina, it will be stable. Near-term resistance expected around $7.20. Key resistance higher, $8. Near-term support, $6.30. So if you are attracted by the dividend yield and you think the business profile, company profile is stable, then I think $6.30 is a good entry level. Key support is expected around $6. Bank of China, okay, operating income is forecast to grow around 3%, low and steady. Cross-border payment services and RMB internationalization are key growth areas. Earnings, expected net profit growth of 2.2%, but don't expect too much. That is the norm, I tell you, for all the state-owned banks. The norm is low single-digit growth in revenue as well as in profit. Low single-digit growth, but that's already good enough. Market is not expecting high single-digit. This is within the expectation. Okay, dividend, most importantly, dividend per share expected to be 0.248 yuan, yielding 5.7%. Still better than the bonds, the bond yields. Valuation, very cheap. Price to book is only 0.5 times, and price to earning, PE, is 5.8 times. Okay, share price also tells it outperforms the market. Near-term resistance expected to be around $5. Key resistance, 545. Near-term support, 450. So if you manage to buy at 450, you'll be getting close to 6% dividend yield. Okay, so it outperformed the market this year. Ping An, also under the SDR, revenue expected to grow modestly between 5 to 7%. I will speed up. The reason you take photo and then you can digest it later. Don't take my photo, you don't need to digest me. Okay. Investment income, it will be quite volatile because the capital market, it will affect the investment return of insurance company and declining bond yields in China. Just now I mentioned, I make some mistakes there. Demand is strong for Chinese treasury bonds. So the price actually strengthens, the bond yield comes down. So bond yield too low is not good to insurance company. Okay, it will lower their investment return. Okay, so but now Ping An and other insurance companies, they are shifting to equities amid China's stimulus could stabilize returns. And China, the government is also trying to encourage more insurance companies to invest more in equities to prop up, to support the stock market. So this will be the trend going forward. Dividend, forecast DPS, dividend per share is 2.65 yuan in 2025. It will yield 5.6%, more or less the same with banks. So if you ask me, between Chinese banks and insurance companies wish to choose, if you are eyeing a stable dividend return, I think banks are better because it will give you 5.6% dividend yield, and the share price is moving up very steadily. But for insurance company, if the equities market, if the stock market goes up, that would be the bonus. Okay, you may expect more volatility in the price because it's unlike the banks. Banks are more affected by interest difference and also the yield. But for insurance company, it will be also affected by the investment return from stock market. Okay, so you look at the share price. Ping An, it lags before, only until this week it caught up because of the stock market rally. Okay, so you can expect more volatility from insurance company Ping An. So you decide yourself which one you like better, stable or stocks that may give you a bigger upside. But bigger upside also means a bigger downside if you are on the right side of the market. Okay, near-term resistance is expected to be around 55 Hong Kong dollars. Key resistance 58. Near-term support 48. Key support 45. HSBC is also listed in Singapore as SDR. Strong capital position. CET1 ratio near 15% at the end of 2024. High dividend yield, committed to a progressive dividend policy with a 2025 payout ratio expected at 50 to 60%, and share buybacks of 2 to 3 billion US dollars for Hong Kong dollars, that's Hong Kong dollars, for 2025. Capital reduction to increase distributable reserve. Recently, they have the Hong Kong court has approved the capital reduction. So in going forward, they can do more share buybacks. They can pay more dividend to shareholders. Exposure to Asia's growth. Asia accounts for over 50% of HSBC's profits. Cost efficiency. They aim to keep cost growth below 5% with a cost-to-income ratio target of around 50%. Further operations streamlining and exiting non-core markets will boost ROTE. Okay. Near-term resistance, $100, very close already. We're near that. Key resistance above 100 will be 110. Near-term support is expected around 91 and key support 85. Okay. Now we move to Hong Kong. Why Hong Kong? Because time is running out. I think there's another session, right? Yeah. So I need to stop here. I apologize, but I'll let you take the photo of my slides because those are also very important information regarding the Hong Kong IPO. Now this year, Hong Kong has reclaimed the top spot in IPO rankings. So who will benefit? Most importantly is what will benefit. Okay. The next slide is my count of reason why Hong Kong is set to reclaim top spot in IPO rankings. Okay. And then to benefit, one instrument to benefit from the IPO market in Hong Kong is the ETF launched by PhillipCapital Management Hong Kong. It's the only and also the first ETF to track the IPO stocks. Okay, in short, is IPO stocks. Stocks that are listed on the Hong Kong Stock Exchange within the last 3 years. It's ETF, a portfolio of newly listed stocks. Eligible stocks must have a market capitalization above 1 billion Hong Kong dollars and average daily trading volume exceeding 10 million. Okay, so maximum number is 50 largest stocks if more qualified. Okay, these are the top 10 holdings. You can see many familiar names such as Tencent Music, not Tencent, Tencent Music, Beike, Horizon Robotics, Media Group, which is listed in Hong Kong this year, Contemporary CATL, 那个宁德时代, also in this ETF, J&T Global Express, Zhejiang Leap Motor, this is 领跑汽车, Giant, 巨子生物 Biogen, 蜜雪, this is a bubble tea company, Shenzhen Dobot Co, this is it is robotic company. So it's quite diversified. You can see 23.8% consumer discretionary, 17.4% industrial. So it's very diversified. Okay. The ETF price also outperformed the market. You can see it rose from $7 to close to $12. So from the low, it rose. What is the percentage? $5. $5 is 70% from the low. Okay. Another stock that will benefit will be Hong Kong EX. That's the only stock exchange in Hong Kong. Okay, you take the photo. I'll go to the next page. So these are the financial highlights of Hong Kong EX. Okay, share price you can see also very outperformed the market. So near-term resistance is expected to be around 430 Hong Kong dollars. Key resistance 455. Near-term support $400 and key support 370. Okay. To give you an idea of the PE, what valuation Hong Kong EX is trading at now is 30. I think it's 36 times PE. Expensive? No, because historically Hong Kong EX used to trade between 25 times PE. Don't expect Hong Kong EX PE to go to single digit. We have never seen that because Hong Kong EX is the only exchange. And now the daily turnover, as I show you, wow, 200 billion a day. So Hong Kong EX, the revenue and the profit is very stable. So now we expect the earning per share. Earning per share last year was 11 Hong Kong dollars. And this year, is 10.5 Hong Kong dollars. Remember this number. So this year, our forecast earning per share is 11.5 Hong Kong dollars. So you can work out the valuation yourself. Every year, you can expect 10% growth in the EPS because Hong Kong EX is very stable. It will not fluctuate. I mean, the profits will not go up and down. So with 11.50 Hong Kong dollars at $422, you divide by 11. So now the PE is around 36, 37. The peak is around 45. So 45 times 11 is how much? It's close to $500. By that time, you have to be very careful. If Hong Kong EX share price rises to near 500, actually it had risen to, in the previous bull market, it has risen to $500 already seen before in the last bull market. Now it's trading at around 30 odd times. So last topic, this is a topic I really recommend to Singapore investors. Our Link REITs. It's the largest REIT in Hong Kong as well as in Asia. So the dividend yield is more than 6%. Now, the last line, distribution per unit for the year increased by 3.7% year on year to 272.34 cents, $2.72 Hong Kong dollars, 2.72 Hong Kong dollars, translating to a dividend yield of around 6.2%. So it's still paying dividend yield, 6%. And then Hong Kong portfolio, mainland China portfolio, it also has international portfolio. In Singapore, it has two properties, Jurong Point and Swing by Thomson Plaza. Both perform strongly at nearly full occupancy with positive rental reversion rate of 17.8%. It also has property in Australia and London. So, but the maximum exposure will be 10%. You'll cap at overseas exposure at 10%. So you see, it's still a very localized Hong Kong REITs. Okay, this is most important thing. The catalyst, the potential catalyst for Link REIT, because up till now, REITs are still not included in the Stock Connect scheme. That means mainland Chinese investors can buy stocks listed in Hong Kong through the Stock Connect scheme, but not REITs. Even if they like Link REIT very much, they can't buy through the Stock Connect. But it was announced last year by the CSRC, it's a China Securities Regulatory Commission, April last year, that this will be included in the Stock Connect scheme. Specific qualifications for criteria for REITs to be included in Stock Connect are still under development. So if current Stock Connect criteria for equities were applied, only 2 Hong Kong listed REITs would qualify. Link REITs and Fortune REIT under Li Ka-shing, it's owned by Li Ka-shing. So this will be a catalyst on top of the 6.2% dividend yield. I'm quite sure once it's included into the REIT Connect, a lot of southbound funds will, you'll see a lot of inflow of southbound funds. Okay, so this the last slide. Near-term resistance expected at 46 Hong Kong dollar. Key resistance 50. I think it's quite, the chance is high for the price to reach 50 if Risk Connect is officially announced this year. Near-term support $41 and key support $38. Okay, thank you.
Thank you. Right, so I think there's a lot of content. All right, so if you have missed any photo, not to worry, this is on YouTube Live. You can revisit the video in full. The slides will be there. All right, so I think we have a lot of questions for Mr. Louis Wong, but due to time constraint, we might not be able to cover for today. However, what we will do is we will cater